Hi guys, welcome back to Cash Prize. This is our third video in our Journey to Financial Independence series, and the subject matter of this video can be the difference between gaining or losing money on the stock market. You know, they say failure to prepare is to prepare to fail, and this saying could not be more true in the stock market. It is an incredibly competitive market that really can ruin you if you underestimate its potential for volatile swings and misleading trends. At the time of posting this video, the stock market is surging despite the prospect of one of the biggest drops in global economic activity in recorded history. And this, I think, is driven in part by millennial investors treating the stock market like a video game, buying stocks which I'm afraid will massively disappoint once economic reality strikes. So in this video, I want to talk about examples of the kinds of stocks I believe people should be looking to buy, how to choose solid stocks for your own portfolio, and why ultimately, above all else, the economy is your true guide in the stock market. Number 1. Examples of stocks to buy. Now before I go any further, please note that this is my own opinion and only examples of stocks to buy based on my own personal research. The market changes through time, and what makes sense one day might not make sense the next. However, I believe the principles underpinning my choices are sound and ought to be useful to you. So right now, it's the second quarter of 2020, and the COVID-19 pandemic has caused a massive economic shock. This calls for a fresh evaluation of the commercial landscape, as well as an educated guess of what the economic landscape might look like post-COVID-19. Naturally, businesses are vulnerable to the huge uncertainty surrounding the pandemic, and so it makes sense to buy stocks of companies which are relatively resistant and resilient to recession and a socially distanced economy. The first stock I will discuss is relatively risky, but potentially offers higher returns. That stock is Zoom. It's a company that has really thrived through the pandemic because its video conferencing software is very easy to use, both in a professional and social setting. It does have big competitors though in the shape of Microsoft and Facebook, but I think that it has good potential for growth, particularly if people permanently shift to working much more from home in the future. The next stock I'm going to look closely at is Netflix, a much more conservative investment. I don't think I need to explain why this company is succeeding at the moment. Aside from the likely socially distanced future we will all be living in, it is already taking on the established Hollywood studios and becoming almost a commodity service for most households. It also faces big competition from the likes of Amazon and Disney, but I believe it has a resilient business model, and I suspect it is likely to continue its growth over the next 5 years. Finally, the third example of a stock I would invest in is the Goliath that is Microsoft. It's a very well established company that I believe will also see gains in a post-COVID-19 future. Its price is currently upwardly trending, and I believe it has scope for greater growth in the future. It's a competitor to Zoom, and likely will also position itself well as a professional video conferencing service to businesses. You will notice that all my choices are entirely technology related. This is because of the uncertainty over the pandemic. They are not going to give me high returns now, but long term, I believe that they each offer a reasonable prospect of gains over the next 5 to 10 years or so. Number 2. How to choose your own stocks. Now this is a skill which demands a focused mind and a resistance to impulsive thinking. The best way to choose stocks is simply to use the unprecedented mountains of information at your fingertips. This information essentially comprises company financial reports, market statistics, news reports, and key economic indicators. Using the stocks I have mentioned, let's look at 3 of the key values and what they can tell you in terms of making your own decisions when choosing stocks. Key value 1. Earnings per share. Now this number simply reflects a company's profits divided by the number of outstanding common stock. It represents a company's profitability. The higher the number, the more profits are available to distribute to shareholders or to reinvest for future expansion. So it's a good number to look at when assessing a stock's inherent value. At the time of posting, Netflix had an EPS of around $3.85 and Microsoft was at $4.75. Both quite healthy in my view. In contrast, Zoom had an EPS of just 9 cents. On the surface, this would indicate a stock to avoid, but this is also where the risk and the potential for reward goes up. I think the company's earnings will grow a lot more into the future. No guarantees of this, of course, but certainly a calculated risk to take. Key value 2. Price to earnings ratio. Now this number is essential to understand when choosing your own stocks. It's obtained by dividing the current stock price by reported earnings per share, that is, the EPS. It gives you an insight into the extent to which a stock might be over or underpriced. Think of it like this. The PE number represents how much you need to invest in the stock in order to obtain $1 of the company's earnings. At the time of posting, Netflix's PE number was $108.58 and Microsoft was at $39.53. This suggests that Netflix is perhaps slightly overpriced relative to its earnings, whilst Microsoft might still be underpriced. Zoom's PE number was very high indeed at $2,570. Indeed, on the surface, this indicates a hugely overpriced stock. However, this will all depend on the performance and earnings per share of the company in the future. It's certainly more of a gamble to invest in Zoom when compared to Microsoft and Netflix, and this is something to think about for sure. Key value 3. Beta. This number is a measure of a stock price's volatility relative to the average volatility of a national stock market. It's useful for assessing the stability of the company's stock price and how likely it is to really plunge or really rocket in value. A beta score of 1 means that on average, it will move in the same direction as the market, which can be up or down. A score of say 1.5 means that for every 1% move in the market, the stock will move 1.5% in the same direction, that is, showing a greater swing. The higher the number, the riskier the stock. A beta of less than 1 is a conservative bet and more resilient to market changes. At the time of posting, Netflix had a beta of 0.96 and Microsoft was at 0.92. Both scores indicate conservative investments. On the other hand, Zoom's beta was negative at 0.11. This means that for every 1% move in the market, Zoom's stock price would move 0.11% in the opposite direction. This again indicates the risk involved in investing in Zoom and why it's important to factor these risks into your own decision-making process. Number 3. Ultimately, the economy is your guide. Every company is susceptible to changes in the economy, and therefore, above all else, your stock choices should be grounded in the performance of economic indicators such as inflation, unemployment figures, growth numbers, and interest rates. The role of national governments and central banks is to enact fiscal and monetary policy to control these numbers. Why? Because they heavily determine economic activity and therefore the profitability and value of stocks. Right now, the global economy is set to see a massive contraction, and so the wisest advice to any investor I can give is to exercise extreme caution in the markets. Don't submit to reactionary thinking caused by a fear of missing out. Plan your portfolio carefully and make sure you are fully aware of the risks associated with your own portfolio. Until the economy is back on its feet, I believe we all need to tread carefully. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.